Hello, I'm Emilie Bellet, founder of Vestpod and author of You're Not Broke, You're Pretty, and you're listening to The Wallet. Every week we bring you the best tips, guidance, and a good dose of inspiration to help you manage your money better. Today's episode is about what drives investment outcomes and how to think about building a portfolio over time. My guest, Jessie Kwok, is Chief Investment Officer at Wealthify, where she oversees how portfolios are built, managed, and adapted as markets change. We talk about why asset allocation often matters more than picking individual investments, how to think about your level of risk, and the decisions that tend to shape long-term results. We also unpack what can help investors stay consistent through volatility and how to approach building a portfolio you can stick to. As always, this episode and the content available on vestpod.com are for educational purposes only and does not constitute financial advice. The value of investments can go down as well as up, and you may get back less than you invest. Jessie, thank you so much for being here with me today on The Wallet. I'm really happy to delve into investing with you. So I think we're going to go straight in, and I'd love to know, what is your role? What is a CIO? And what's your day-to-day?
Right, great. Emilie, it's so good to be here with you. Thank you for having me today. CIO, well, it's a grand title, right? But honestly, I just ask a lot of awkward questions in meetings. My team absolutely hates it, right? But I suppose like many things in life, it is about asking the right questions. So as a CIO, I ask the questions often like, are we investing in the right mix of assets? If there are some new trends, are we investing in the trends? Are we taking the right level of risk? But just as importantly, why we are not investing in something is also on my mind a lot of the time. So my team and I work quite hard to answer these questions, why we should be investing in something and why we shouldn't be investing in something.
And when we talk about investing, most people think investing is about just picking funds and picking stocks. And I guess at an individual level, people think this way. But what is it really about?
Of course, picking funds and picking stock is important. It's part of the process. But for me, investing is having that clarity of what you're trying to achieve with it. And having that clarity would tell you how much risk you should take. And I know that some of your guests on the podcast has said the word risk, it's a bad word because it has got negative association that really puts people off investing, especially females, right? But if we think about it, we take risk every day, right? So striking up a conversation with strangers, that's a risk. Being kind is a risk. Wearing white to dinner party is definitely a risk. So for most of us, we need to have our goal in mind. And the goal is having a secure financial future. And to get that, we must take some risk for it. Because so often, the return that you get from an investment is how much risk you take. So you will need to be able to stomach that ups and downs to get the thrills. So much of investing is getting used to that ride, right? And then we talked about female and risk. Actually, at Wealthify, we're quite proud, really super happy that this year, our new customer, over half of them are females. So we feel that the conversation might be changing.
That's amazing. I'm super happy to hear that, women are part of the conversations, and that's what we see more and more. What do you think are the few decisions as an investor that will drive long-term outcomes in a portfolio?
I'm afraid I might give you a plain, simple, boring answer here, right? So a few things that I can think of is start investing, take some risk, and stay the course, right? So people with savings to invest, typically they have got a long time horizon. And what I mean by that is they don't need the money for another 10 or 15 years. So you should really start using that money in investing and let some of that money grow, right? And we've just talked a bit about risk. So once you are invested, you must stay the course, right? That ups and downs, that ride, you have to stay on the ride.
It's not easy.
It's so super hard because you will have headlines screaming at you every day. And sometimes it feels like bad news is everywhere. And you think, oh my God, this is not for me. This is too hard. What am I doing? I must do something with the investment. But that is when doing nothing is precisely what you should be doing. Doing nothing feels passive once you're in the market, but that actually is the principle and that is the discipline. And when some dips come along, don't be too afraid to buy.
It's such a good reminder of, consistency, staying the course, but that's also really hard. But we'll talk a little bit about when you actually sell also, because that's important that, at some point you will need your money back. Why does asset allocation matters more than picking individual investments?
Asset allocation. We can talk a bit about that. My company loves me for it. So you might laugh at this. So I talk about investing, as you can imagine, internally, right? So last year, I've started this cooking analogy for asset allocation. So how I see asset allocation or portfolio management, if you like, is it's like balancing your diet, okay? So too much meat, you're going to be bloated and uncomfortable. But too much vegetables, you are still hungry. So striking that right balance is the most important. So I see equity as meat. That drives your long-term investment outcome. It drives your performance because it's quite closely tied to economic growth, right? And any individual investments is built on that. Okay. And vegetables is your defenses. So when the market experiences downturn, it would help. It's very handy and is smoothing out the volatility. Now, what the mix that is on the plate is really important. You want to make sure that you've got enough meat, but also have some vegetables. You want to be full, but not uncomfortable. So you want enough return and be balanced at the same time. So, and then when it comes to individual investments, think about it. What the meat could be beef or lamb. The vegetable could be spinach or kale. Vegetarian options possible. And therefore, the quality of those ingredients are the most important. But whether they're beef or lamb, as long as they're good quality, it will do the job.
That's brilliant. And I think it's really important to understand that, rather than going for, individual assets, which is also quite tricky to pick investments, going for something that's, more spread out. We organize lots of boot camps and classes, and often individual investors will focus on the wrong thing, or maybe something that won't have a positive impact on their portfolio. What move the needles? What does matter in investing?
I think in investing is, again, staying that course is so important, right? We shouldn't focus too much on short-term noises. And sometimes they might be political noises because eventually they don't really drive economic outcome. So if the economy is growing or not, it has very little to do with it. And if every time we see a bad headline and we sell everything, we never be investing, right? So being able to block out some of the noise is quite important. And sometimes, I suppose, investors or individuals can sort of sit around and wait for the right time. It never feels right. But that's probably pretty much doing anything sometimes. There is never a right time, but more often than not, now is the right time. It's almost like, sitting in a bus stop and waiting for that bus to come, and you think, well, should I walk? Right? You're like, no, actually, I'm going to wait for that bus. Walking probably get you incrementally closer to the destination. And at the end, it might be marginally quicker and you can wait, right? But it would never be quite right. And when that moment comes, you are still unsure. So now is always a good time to do it, because historically we do see that market tends to go up more than it goes down. So there is an argument looking at the data to start as soon as possible.
You're a CIO, a Chief Investment Officer. How do you approach investment risk?
For us, definitely risk is the permanent loss of capital. So when I say that, I mean they are losses that you cannot recover from. Now, it is quite important to draw the distinction between that and volatility. So volatility goes up and down. And we know that if you have a good foundation in choosing your investment, then there is a good chance that when it drops, they have the foundation to grow again. So it is really important to think about it in that sense. So therefore, when it comes to individual investors thinking about risk, then you definitely want to give it enough time so that if the investments do fall, it will have time to grow back.
So give some time to your investments, and ideally you don't need the money, for your next holiday or for the short term. Can I ask you how do you approach risk in terms of portfolio building, maybe, and allocation of assets? Because people will have, some equity. You talked about that. They'll have some bonds. They probably have some cash. How do they work out the mix of investments?
So again, it goes back to what we talked about in terms of goals, right? So if you have a very high risk appetite, then you buy one stock, but it could go very wrong, right? So having that balanced view of asset mix is quite important. So then it comes to risk, right? So we know that equity have risk that ties to economic growth, but also within equities, some of them is more sensitive to growth, some of them is less sensitive. So we want to make sure within equity, we have got a good balance of that risk. So when market moves, they complement each other and reach the final destination, if you like, in a smoother path. Some people don't so much like all equity, perhaps feeling like that is too ups and downs. The ride is too exciting. So sometimes you put some bonds in it. So again, that cushion some of the volatility. So moving up and down, a smoother ride, but again, it'll be a sort of lower outcome, if I can say that.
And then when we look at this portfolio, you talked about, sometimes the market volatility, we have, conditions that are changing. How do you adapt your portfolio with what's happening out there on the markets?
Yeah, that's interesting. So I suppose if I look back in the last 2 decades that I've been in market, there are perhaps 2 things that drive multi-asset portfolio. So a portfolio that has got both equity and bonds, we call them multi-asset portfolios. So after the financial crisis of 2008, you know that a lot of global central banks around the world have cut interest rate to a very low level. And that is sort of the time where you see a lot of multi-asset portfolios start buying more equity to drive that return. So a lot more equity risk in that. And in that time, people have gotten used to equity risk. And that really have shaped balanced portfolio in the last 20 years. I can't believe I've been in market for 20 years. So that's one thing that I can think of. Another thing that I can think of is the rise of ETFs. So it's more than However, it's easier to get diversified exposure to both broad market and specific equity markets as well. So then you will see that a lot of portfolio managers is favoring passive instruments over active instrument. So those I can see like the two drivers that we were adapting to manage the portfolio. So covering both asset allocation and fund selection, as we talked about. But obviously, since 2022, interest rate is back in fashion. So a lot of managers are now putting bonds back in the mix. So it is quite interesting dynamics.
Yeah, it's interesting to see the evolution and have a a bigger picture. Because when you invest, sometimes you're very in the nitty gritty and looking at your investment and the details. But it's interesting to see the trend. Can you just remind us a question we often get is what's the difference between ETF and index funds? And I think that's quite helpful for people to know.
Yeah, and it is not easy to explain as
so much jargon,
right? Yeah, it's a lot of jargon. When it comes down to it, it's a lot of technicality as well, right? So ETF is short for exchange traded funds. So typically they are diversified instruments that you can buy on an exchange through a brokerage, etc. Index funds are instruments, again, diversified instruments that follow the broad market that would replicate the performance of an index. Fun fact is that not all ETFs are index funds.
So to add to the complexity.
Yeah. So it really is a minefield to navigate for individuals, isn't it?
Yeah, it can be quite tricky, and there's tens of thousands of different funds you can choose from.
Yeah.
We were discussing just before that, the volatility on the market. How do you decide whether volatility is just noise or it's something that requires your attention and potentially to take action?
Right. It comes back to asking the right questions, right? So when market drops, we want to understand the events that are driving it. And if those events mean that we have to change our long-term view on the economy or on the portfolio. So quite handily, every 6 months, we try to set the portfolio direction. So we gather all the data that we monitor, we do the analysis and say that, based on probability, this is the direction that we think the market will be going. So therefore, it is good to invest in these assets. Great. We write it down. Yeah. Very useful. And then when events happen, that market drops, responding to that, we go back to that list and score ourselves to see if our original thinking was still true. We challenge ourselves, we challenge each other, a lot of debating, as you can imagine. So then we'll have the clarity to know if we need to change direction or not. So that is pretty much what happened when we encounter volatility. So we sort of ask ourselves, do we have to do something? Or is everyone just having a bad week?
Yeah, of course. It's a difficult one, especially as an individual investor, not to overreact, to stock market fluctuation and as you said, the noise, and especially when investors tend to get the information also from sometimes social media or the news, then it can be quite tricky to stay on track. Do you have any tips for those investors who find it hard to stay consistent and think, okay, I'm going to hold my portfolio for the long time, whatever happens?
Yes, difficult market is difficult, is in the name, isn't it? So I think upfront, I just want to acknowledge that volatility affects some people more than others, and it's absolutely okay. Volatility, difficult markets could be emotional. It could be daunting. Knowing that is really useful because half the battle is knowing yourself, knowing how you react to things. And this insight actually came from a friend that I talked to a couple of months ago, and she's a fund manager as well. And she said to me, Jessie, I think you're more affected by volatility than me. I'm like, okay, thanks. I appreciate that. So then that gave me that insight. Oh, you know what? Some people are more affected by it. Now you know that. That is how you react to events. Breathe. Then we go back to the theory that we know historically markets have tended to go up over time. So that gives you some comfort that perhaps there is a good chance that it will recover. And also, historically, we have seen that some of these dips are actually quite good opportunity to think about investing. Of course, no one can call it perfectly, but that's what we see in the data.
This episode is sponsored by Wealthify. Want to start investing but not sure where to begin, or perhaps you don't have the time to manage it yourself? Well, Wealthify makes it simple by choosing and managing your investments for you. And if you deposit or transfer into their stocks and share ISA, you could earn between £50 and £1,000 in cashback. Open your account at wealthify.com. Terms and conditions and minimum investments apply. Registration closes on the 31st of May 2026. With investing, your capital is at risk. Wealthify is authorised and regulated by the Financial Conduct Authority. I remember when I started investing, I think the first years can be really frustrating, even if you're investing in a difficult market, because you don't see positive returns for a long time. And it takes time anyway. You talk about this, decades of investments where you tend to see positive returns, but it's about being really patient as an investor.
So patient, yeah, and not freaking out, not panic. It takes a lot of emotional stillness, if you like. We can all meditate more, I suppose.
Do you feel you got used to it, to the not freaking out about the markets?
We are all still human at the end of the day, right? And we don't always get it right. This is just part of the game. But in general, I think we take risks quite well. But it is still very emotional for me.
Yeah, okay. I'm sure.
And it is hard to admit it sometimes, but it is, and that is just the truth in that. And also, I think it's never lost on me that it is such a privilege to manage people's money, that people place their trust in me, my team, the company, to look after their life savings, right? So I think it is natural that we feel a bit of that weight on our shoulders.
Another question that I'm asked all the time is, okay, my portfolio is probably going up, or maybe it's going down, but when do I sell my investment? At some point I will need my money, or maybe the markets are not performing the way I want. So when do you sell your investments?
So for me, investing is a strategic choice. So if we follow that logic, selling should also be a strategic choice as well. But so often you see markets dropping, you have that visceral panic, and then you think, this is just not for me, so I must sell. Right. Very often when you have that urge to do something about it, it's probably too late to sell. Mm-hmm. Market has reacted already, and you're risking selling at the bottom. And that goes back to what we've talked about, locking the temporary loss as a permanent loss. So for long-term investors, you sell when you need the money for something else. You've got another use for the money. And very often they are big life events, like buying a house, getting married, maybe starting a business. But I would say that when these events happen, give it plenty of time. Plan ahead. Because when you plan ahead, you have got the flexibility and control over the timing of selling, and then you won't be a forced seller, which means that you're forced to sell whatever the market level is. So planning ahead in this situation is so important. So then you have got that control on the timing.
And in terms of, if we go back to the portfolio for a minute, what is the difference between you building your own portfolio yourself or using a managed portfolio?
Well, of course, building your portfolio means that you have got all the control, all the flexibility on what you want to invest in that might align to your own beliefs, align to your own value. You can pick a stock, you can pick a fund, whatever you want. Now, but that obviously comes at a cost. There's no free lunch in life. So when you manage your own investment, you got to have the tools to monitor what risks you are taking. You got to manage it in the name. And you got to make all the decisions on it as well. So it's both time and knowledge in that case. Now, versus a managed portfolio, so there, everything is done for you. All the decision making, all the trading, all the monitoring. You can feel easy that the risks are being monitored for you and that you don't have to worry about it. But obviously, you have much less control over what you put in, where you put your money in. But let's face it, we have a job, we have a family, we have a life. So who has got the time to monitor the market at 11 p.m. at night? So that's why I think at Wealthify, we are very set on offering that managed portfolio for people, because this is literally giving them the time back to do important things and exciting things in life.
I mean, you talked about emotional reaction, but what are some common mistakes you see people doing with their investments?
Now, I don't see everyone's portfolio, so it might apply to you, it might not apply to you, okay? I think I see two camps. One is when they take way too much risks. So they take risk in a few stocks, and those stocks go up and down like crazy. And some of them sometimes don't work out. But when you have that panic, you sell at the bottom.
Yes.
And that doesn't work out for anyone. And now you're probably swan off investing. But on the other hand, you have people taking way too little risk. So their money is in savings and not in investing. So even when they are invested, they are perhaps not investing enough, or the risk that they're taking is too low. And I think a lot of us are in that camp because, like you said, it's not easy. The ride is, quite wild sometimes as well, right?
And Jessie, from your perspective as a CIO, what tips do you have for someone who has lots of savings and cash and not really investing at the moment? So where do people start with investing?
Well, inflation is the biggest enemy, right? So starting small, starting to invest in a diversified instrument is a great start. So I suppose a good tip would be find someone that you trust, help you with investing a bit, hold your hand a little bit if you are not taking enough risk. We have to at least beat inflation. So sometimes money in savings feel good. The numbers doesn't move a lot. It's always that number.
It's
Save. But really, the money is being eroded away by prices going up. So, in fact, the money is shrinking. You just don't see it on that paper. So I think those are some of the things that I observed.
Yeah, and definitely, when you're quite new to investing, and I've seen, especially around workplace pension, people who, just sign for for any level of risk that tend to be usually quite low for what they want to achieve, or they tend to be quite young. So it's about reviewing your investment, and probably looking at managed portfolio is also a good idea.
It has that holding hand element to it, which is quite reassuring sometimes.
Yeah. What is genuinely hard to get right in portfolio management, even at your level?
Again, I think we talked.
I really want to know.
And I think I talked about it a little bit, that we're human. We don't get everything right. It's difficult. But I think one of the bigger thing would be timing. So what I mean by that is you have a good idea, but the timing of going in could be better. So that is always one that haunts us slightly. But we need to remember that we're a long-term investor. So timing the market is less important than staying in the market. So we also want to stay true to our own philosophy. But this is my day job. So we want to get it as right as possible within our ability. And we talked about that it is emotional. So after 20 years, it's still emotional for some of us, including me. And that is purely that we've got that responsibility of looking after people's money, that enormous trust that people place in us that we don't take lightly. But, I'm trying to manage that as well. And I feel that if it was ever too comfortable, then perhaps I'm not doing my job right, that I'm not asking the right question.
Yeah. And maybe you could give me an example or any, recent portfolio decision and how you approached it.
Oof. I don't want to give too much of the secret away here. when really the secret is a lot of work. So if I take us back to late last year, 2025, and you would know that there is a group of mega cap US tech company that the industry endearingly named Magnificent Seven.
Yep.
We know that at that point they had 2.5 years of good run, a lot of momentum in that stocks, driving a lot of stock market performance. So sort of November, December time, we were just asking questions around that, looking at that and think, you know what? These companies are getting a bit too expensive. If the momentum is not with us, what have we got in the portfolio to have that defense when they don't perform so well? But at the same time, we know that we are still very confident that the market, the economy is really robust. We weren't seeing a lot of evidence that economic growth will fall away. So then we thought, you know what? Let's get into a segment that would help us safeguard some of that return. So we bought into the value segment of the market. A bit technical, but what that means is that we bought into companies that are not as highly valued as those US growth company. So that's an example.
Yeah, that's fascinating. You just mentioned the Magnificent Seven. What are your approach to looking a bit broader than just maybe these tech companies?
Yes. So in the equity market, there's actually a lot more segment in it. So we very typically at least monitor 20 to 30 of these different segments. So it could be sectors, it could be, again, it's very technical, different factors, elements that drive the markets. So we try to get a handle on which bit of the equity market is doing better than others and which bit might present value. So essentially, we're trying to gauge where the next return driver might be.
What should investors actually do during a market downturn?
It goes back to so much we've said already, isn't it? So I give you 3 points there very quickly. First one, you breathe, you hold tight, you stay on. Okay, so breathe. Second point, you want to look into why the market has dropped. So again, it aligns to our process as well. If an event happens, why it happens, right? And a lot of the times, by the time it has happened, it's too late to sell. Market has reacted already. And like we said, historically, we do see bouncing back in market. So perhaps it's not too bad a time to think about exploring investing, putting a bit more money in. But really is just breathe, stay on, think about putting more money in.
Make sure you note, take a note of this episode. Thanks, Jessie. Also, another topic we were discussing just before is AI, artificial intelligence. Everywhere now in all conversations, in the podcast, we keep talking about it. Do you use it? Do you invest in it? What do you do? Do you think AI is useful in portfolio management? And maybe where is it overhyped? Or maybe it's, again, a timing thing and we're not ready yet?
Yeah. AI is taking everyone by storm. All the industries, so many industries, and finance is no exception. It is coming to us as well. But I feel that it's still quite early days in its application. So people are still trying to find practical and structured way in using it. So for now, for us, what we have seen is that AI is good at picking up not so glamorous tasks like collating data, summarizing research, spotting pattern. So that's been so helpful. And especially we're a small company, we've only got small teams. So using that really expand capability in small teams. But I suppose one thing that AI is not doing, and perhaps it will never do, is to take risk for us. So to take risk, you need to have a conviction. You need to stand behind that conviction and that decisions when it goes your way, and when it doesn't go your way, you have to make a choice to be in equity, in a certain equity or not. So I don't see AI doing that for us, but who knows?
Let's talk a little bit about, maybe portfolio construction or any trends or, any structural changes you see coming over the next month and years.
So some of the things that I'm thinking about, so we've talked a lot about equity because, again, equity drives so much of portfolio return, investment return, that we got to spend some time thinking about it. And you see a lot of the global trackers have very high concentration. That means a high proportion of it is in a few companies. So you got to ask yourself if that is the exposure that you want. And if that isn't, then what is? So having that clarity in the risk that you're taking is important in going into these markets currently. And we talked about risk management a little bit as well. So how do we build defenses should various things happen? And as we've talked about, market conditions change, trends change. So sometimes the defenses that were defensive before might not be so effective in the future. So we got to be able to follow those trends and look at those relationships as well. And of course, there are always multi-year trends in technology, not just in the tech sector, but in healthcare, in industrial sector, all of that. So it is quite important to stay on top of some of these multi-year trends because making sure that you're in some of those trends could mean quite some good return in the portfolio.
Yeah, that sounds great. And if you were starting from scratch today with like a small amount of money, I'm not going to ask you about the portfolio you will build, but maybe what are the principles you would follow?
Yes. So if I start again, have a very small amount of money.
20 years.
I was young once. If I have a small amount of money, I would definitely invest from day one.
Yeah.
I think looking back, I remember that feeling of unsure, that feeling of doubt. But again, when are we ever going to be ready, right? So it feels that if we have to wait for that perfect moment to be ready, we might never get there. So now is usually a good time. So starting investing, do it now. And I suppose the last thing that I would look at is also the cost that I'm paying. We haven't talked a lot about cost so far, but knowing what you're paying and deciding if it is worth paying is very important.
What is one thing you wish more people understood about investing?
I give you two things.
Yes.
Risk is not bad. And that investing is more likely to give you a more secure financial future than savings alone.
Okay, 3 quick fire, Jessie, you ready?
Right.
What is the biggest myth that holds people back?
The biggest myth is investing is overly risky and you need a lot of money for it.
What actually matters that people ignore?
People ignore costs.
One rule you would apply to your own money?
The rule that I will apply to my money is don't stick it all on red and have some spare cash.
Amazing. Jessie, thank you so much for talking all things investing and asset allocation and risk.
Thank you so much. It's been such a pleasure being here. Thank you.
Thanks. Thank you for joining us today on The Wallet. Before we wrap, a quick reminder, this episode is a general conversation for educational purposes and not financial advice. Investing gives your money the opportunity to grow over the long term, although returns can rise and fall with market conditions. You can subscribe to The Wallet on YouTube or your favorite podcast platform. We share short clips on social media at Vestpod, and you can find the key takeaways and resources from this episode at vestpod.com. If you'd like to go deeper, you can subscribe to the Vestpod newsletter via the link in the show notes for practical money insights, episode summaries, and updates on upcoming events.